Hello, everybody. Good to see you. It's good to have a full house here today. I'm Todd Knuckles. We're going to have a great discussion today on financial strength, and specifically financial strength as it applies to business owners, because I know you're probably not an accountant, and I don't want you to be an accountant. I just want you to be able to read your financials, interpret your financials, and make good decisions based on your financials. And that's really what it's all about. A little about me. I have been doing this for 27 years. I've worked directly with business owners throughout North America and helped them to do a variety of things from financial improvements to organizational strength to sales and marketing and everything in between, which is hiring, training, terminating, counseling, you name it. I've done that. I wrote a book called The 80/20 Business, which is actually an Amazon bestseller. And so that's an important part of what I do. It's my model, and I'll be happy to share that with everybody here and give you a complimentary digital copy of that. I've written in a bunch of magazines, spoke on a bunch of stages, and you can find me all over. And going through podcasts. So today, of course, I want to take a step back at the beginning here, and I want to explain why I call my business 80/20 Business Coaching. Now, this is based on the Pareto Principle, which is the 80/20 rule, which is 80% of results tend to come from 20% of efforts, good or bad. And so we have to take a look at a lot of that, because what I realized early is that business owners don't need more on their plate. They actually need less on their plate. And that's really why I call my program what it is. And at the end of the day, you do need less. I mean, because you're a business owner, you have all these plates spinning, you have so many things on your plate. What matters? And I'm going to talk about that, and then we're going to get into the financial strength part. And what I teach owners is what to focus upon and then what to eliminate, because not everything on your desk has equal importance. And that's an important thing for business owners, because they think everything sitting there is equally important. It's not. And so we have to get away from that every time we can. So one of the things I also teach is that it's not the 80/20, it's the 80/20 within the 20%. And so when you do the math, and I'll do it for you, when you do the math, that means about 5% of what you do every day gives you about 50% of your results, good or bad. Now, let's take it a step further with everything. When you're selling and who you sell to, about 5% of your customer types equal 50% of your sales. Now, let me explain that. If you are B2B, then that means, specific markets, typically your top 10 equals about 50%. If you are B2C, that means you have to get into demographics. You need to know your customers. Where do they live? Are they married? Do they have children? What cars do they drive? What size houses do they have? All of those things, if you just analyze your data of who you've made money from in the last 6 to 12 months, you will find there are specific types. Now, why is that important? Well, that's important because then you can focus your marketing efforts, you can focus your talents on people that matter most, because not every customer matters. Very certain segments matter more than others. So keep that in mind with all of that. So that's the first thing. The other thing is, for you personally, 5% or so of your activities equal 50% or so of your results, good or bad. And so by doing that, what I want you to understand is that small things matter most. And that's an important part of this process. And it's a state of nature. I like to golf. And so when you take a look at golf, this applies 100%. And in a typical golf bag, you will find about 14 clubs, no more than 14, sometimes less. But anyway, 72 strokes equals par. And there's one club that's designed to be used 50% of the time. Guess what that is? Well, that's the putter. There's also one club that if you go to any driving range in the world and you take a look at, 99% of the people there are practicing, and that is the driver. Why? Because it's fun. However, in golf, the club that's used 50% of the time tends to be practiced about 10% of the time. And the club that's used about 20% of the time tends to get practiced about 80% of the time. Applies to everything. So keep that in mind when you're applying it to your business. I just want you to understand that. So at the end of the day, if you want to get better at golf, you practice more of your putter than you would your driver, but it's human nature. We tend to like to do things that are more fun, and we do it with our business as well. In business, here's what happens. We get busy with meetings because many times if we schedule 10 meetings, we feel busy, we feel like we're doing something, and guess what? We're not. Answering emails instantly. That's the killer. We hear that ding go off and we run to the computer or our phones nowadays, and we do that. Going to networking events. A lot of times we feel like this is working, but a lot of times networking events are actually not working events. We go there, we talk to the same three people, we have some coffee, some drinks, some social things, and nothing gets done. Selling to the wrong audience. I mentioned that earlier. About 5% of your audience will give you about 50% of your results. For B2C companies, it's different than B2B, but you have to understand that. And for wasting advertising dollars, going after people that don't matter, that's on us. And selling the wrong product lines. Many businesses out there have 5, 10, or more product lines. But when you analyze it, about 50% of your revenue is coming from about 5% of that product line. And that's an important thing to understand. And once you know your numbers, you can spend dollars more wisely. So I'm going to finally give you this before we jump into the actual content today. I'm going to give you an exercise I created called Finding the Fives. And what I want you to do is list all of the activities you do as a business owner, everything you do from morning to evening, everything you do. Now, rate them from 1 to 5. 5 activities are the things that bring you cash the quickest. Anything that is less than a 3, I want you to eliminate or hand off, and preferably a 3, 2, or 1. I want you only working on 4 or 5 activities. And if you start to do that, that's going to help you to figure out what matters most in your business, which is all that matters. Your business is the only thing that matters. So hope that helps. Now, let's get into the content that we came here today for, which is building a bulletproof business. And this is, we're going to start part 1. We're going to start on the financial side. Because if you don't build a bulletproof financial business, nothing else matters. I mean, it's game over. You've ran out of quarters in the old days when you're playing the game. You ran out and you go home. And so I'm going to teach you a very, very simple way to analyze your business. Something that will give you comfort at the end of the month when you take a look at your financials. And again, you do not have to be an accountant to do this. That's the most important thing. I've taught this for 3 decades, and I teach it from a standpoint of a business owner and all the basics that they need to know. Okay, so let's dig into this a little bit deeper with all of this. So the goals for the day. Number 1, I'm going to go Financials 101. We're not going any deeper. Everything is just adding, subtracting. There's a little division, but that's it. That's all you have to do with a lot of this. We're going to talk about the 3 key financial statements that you need to look at. Number 1 being your balance sheet. Number 2 being your profit and loss statement, which I will tell you that 9 out of 10 business owners, that's the only one they look at. That's it. They look at that, and they look at how much cash is in the bank. That's it. That's all they look at. But the one that we miss, and the one that's really more important, is called the cash flow statement. In fact, most accountants will not even provide this. You have to ask for it. But this statement tells you truly where the cash is going, and that is vital. That's really vital with everything that we're doing. So I also have created a system. I keep it simple: green light, yellow light, red light. Just like it sounds, and it tells us whether we're doing well in all of this. And I'm going to teach you how to analyze your financials in 10 minutes or less, matter of fact, 5 minutes or less in most cases, and apply a green light, yellow light, red light application to them, more importantly. So let's start with the balance sheet. The balance sheet is your scoreboard. This is what you need to be looking at the end of every month. It can only be looked at the end of a period, a month, a quarter, or something like that. But you look at it at the end of the month, and it tells you the score. It tells you whether you are up or behind. It tells you, if to use football terms, how many touchdowns you're up or how many touchdowns you're behind. It also tells you how much time's left in the game. And by that, I mean how much time is left in your business game. In other words, are you close to running out of money? And the balance sheet will tell you that. But the good news is that you can predict all this ahead of time. And then you can make adjustments and improve it. Now, the balance sheet in its simplest form are assets, which are the good things, and then liabilities, which are the things you owe. And what balances it is owner's equity. And so the name of the game is to increase owner's equity. And if you don't, then you're going to go out of business and you're going to become debt heavy. Now, let me show you specifically more on a lot of this. Now, many people don't know this, but within the balance sheet, there are current and non-current portions. What does that mean? Current assets, current liabilities. Now, the magic number that determines that is 12 months specifically, and I'll explain that more. When you look at your balance sheet, you're going to see current assets, you're going to see current liabilities, you're going to see, if it's done correctly, many times it's not, but you're going to see these two distinct categories, which are really, really important on here. And in current assets, it's cash and any accounts receivable and anything else that's going to turn into cash within 12 months, like inventory, accounts receivable. Now, not all businesses have accounts receivable. Not all businesses have inventory. If that's you, direct message me. I'll give you my information at the end of this. I'll tell you another thing to look at within your business, but cash and things that turn into cash within 12 months. That is what you have to understand. On the liability side, accounts payable. You're going to pay those out within 12 months or somebody's coming after you. If you have a note, it's the monthly note payments on equipment and leases and things like that. And it's only the 12-month portion. And let me explain that to you. Let's say that your payment is $500 a month. All you're going to put in your current liabilities is 500 times 12 or $6,000 until you get to the last 12 months, and then it's going to go 6,000, 5,500, 5,000, 4,500, and so forth until it gets down to zero. And that's the way that works if it's set up correctly, which is another challenge within itself, but I can help you with that. Okay, let's take a look at this. What I do, and again, you can pull dozens of different ratios off of your balance sheet. Keep that in mind. The one I personally like, which works really well for B2B and works somewhat for B2C. Again, if you're a B2C, just direct message me. I'll tell you some others that I would use. But if you take in this sample company, they have $175,000 of current assets. They have $140,000 of current liabilities, and they have a ratio, which is 1.25. That means they have $1.25 of current assets for every $1 of current liabilities. Now, is that good? Is it bad? Let me show you the scale I like to use to keep you and turn you into a bulletproof business. If you have a 2.5 or higher, which means you have $2.50 or higher of current assets for every $1 of current liabilities, I call that green light. It's virtually impossible to put you out of business if that is the case. If you're 1.5 to 2.4, I consider that yellow light, cautious, but we still have time to make some adjustments. There's still time left in the ball game. We're not behind that much, and we still have time to make some moves. And finally, if you're less than a 1.5, that's where we have to get a little cautious. We have to figure out ways to generate cash at a higher level so we can start getting this ratio up. So that's the first thing I would take a look at. The next thing you judge on your balance sheet is cash on hand. Now, I will tell you there are, again, dozens of ways, many complex ways of doing this. I'm going to keep it simple. Just take a look at your average daily sales. Yes, 20 business days. What are your average daily sales? If they are $1,000 a day, and if you have $30,000 in the bank, guess what? You have 30 days of cash on hand. And again, there are complex ways to do this. I like to keep it simple. So is that good or bad? Well, I like to use this. If you have 45 or higher days of cash on hand, I consider that green light. Again, that combined with your current ratio, that's a great scenario. 25 to 44, cautious, not bad, just cautious. And then less than 25, red. Now, I will tell you, if you are in a growth mode, it's vitally important to have more cash in the bank, especially because when you grow, cash kind of gets pulled out. And it takes, if you have accounts receivable, it takes a couple of months for that to start to work back in. So, depending on where you are in your business, you can keep this at different levels. But these are the green light, yellow light, red light scenarios I've used now for 3 decades. And then finally, accounts receivable. Now, not all of you listening to this have accounts receivable, but if you have accounts receivable, the goal is to have it less than 30 days. That's green light. 31 to 45, we get a little bit sketchy. And then, of course, if everything's starting to go above 45, that is red. That's a danger Will Robinson situation, and that's where you have to watch out, because now you have spent money and you're waiting for it to come back. And so if you're starting to get a lot above 45 days, then what will happen is you'll start to see your cash position decrease. Things will get tight. It'll get stressful. And so it all works together. But those are the three things to take a look at the end of a month. Now, here's some rules to live by with all of this. You are only as strong as your lowest rating. In other words, you can be a green light in current ratio, which consists of cash and accounts receivable and inventory that's going to turn into cash and things like that. But if your cash position is a red light, you're a red light. And it can be that way because within the current ratio, you could have a lot of accounts receivable, a lot of inventory, very little cash. So it falsely inflates your rating. So just keep that in mind. You're only as strong as your lowest rating. At the end of the month, this needs to be the very first statement you review. And many of you listening here, you get your financials, you take a look at your financials, you don't even look at this because it's so confusing and no one's ever explained it to you. So I'm going to challenge you to look at that at the end of the month. If you have more questions, just direct message me. I'll be happy to help you out with all of that. All of your cash decisions need to be based on the rating system within here. Whether you're green light, yellow light, or red light overall, that's your decisions. Obviously, if you're red light, what we need to do is not buy more stuff. We need to start building up some cash, maybe paying down some debt. It just depends. And so we need to do that. Also, those are things that are important in your business. Now, your balance sheet, you know the score now. You know what you need to do, whether you're yellow light, green light, red light, whatever the case may be. Now, what do we do? Well, now we look at our profit and loss statement, which most of us look at that. That makes sense. So with this statement, we start with our sales or our revenue. We subtract what I call direct materials, and I separate this from cost of goods sold. But anyway, direct materials. These are things directly related to a sale. So if you had $0 in sales, your direct materials would be zero. And keep that in mind. And so for a coffee shop, this would be the cups, the coffee grounds, things like that, the milk, you name it. So just think of that. It's directly related to a sale, and keep that in mind. Then we have wages. So if you have workers, I'd like to put the wages going out the door here, not the owner wages. I like to put the wages going out the door here. And then finally, we have overhead, which are all of our fixed expenses, rent, utilities, maybe computer expense, maybe subscriptions you can't get out of. Overhead is basically things you pay, whether you have $1 of sales or $100,000 of sales. It doesn't matter. You have to pay your overhead items. They're fixed. And so keep that in mind. Now, when you're finished, what you have is net income. Sales minus direct materials, minus wages, minus overhead, net income. Wow, that's good. Well, the problem is many owners spend their net income when that's not the money you get to keep. And that's why we apply the third statement that I'll show you in a few seconds. Number one, let's say you need to get that number up. I would start with pricing. Many times we don't charge enough. And that just gives us a whole litany of issues going through there. In overhead, there are three key things I see a lot. Auto expenses, maybe you have the Porsche delivery truck or something like that. Rent is too high. Maybe you should consider subleasing if you can. If you need to get that down, leases, you name it. Those are the three big areas I've observed over the years on a lot of this. So, those are ways to look. If you want me to take a look at them, just direct message me. I'll be happy to do that. So, balance sheet. We know our score. We know whether we're ahead or behind in the ball game. We know how much time is left in the ball game. Profit and loss statement. We know where our expenses are. We know how much net income we have, but we do not spend the net income. What we look at next is the third statement. Many of you have never seen this statement. Many of your accountants have never produced this statement, but I would request this statement from them. The cash flow statement begins with net income. Everything that was left over from the profit and loss statement. That's an important thing. Then it adds back depreciation, amortization, and interest, those items that were within your overhead of your profit and loss statement. But here's where it gets different. It takes out all the payments. Your note payments are not showing in your overhead. your note payments are separate from that. So you could have, a lot of things going for you, but then you have these payments you have to do. And guess what? That's your cash flow. This is what you get to spend. Now, you don't always get to spend it all. Depends on what your balance sheet says. If your balance sheet says your red light, you definitely don't want to spend all that cash flow. You want to come up with a strategy to get it from red to green and so forth. So let me show you a real life example of what happens here. This sample company, they had $23,000 of net income. And their accountant said, congratulations, you have all kinds of cash. And the person said, well, if I have all kinds of cash, where is it? And that's typically what happens with the small business owners. Well, here's what happened. This business owner spent about $21,000 on different things, capital expenditures. Maybe they changed the office, they changed the equipment, they did some stuff. Then, guess what? They spent another $3,000 on financing activities. They took out some money. They did some different things like that. So at the end of the year, their net increase was only $1,000, not $23,000. And at the very, very end of the year, they went up from $1,200 to $2,200. And this is where a business gets into trouble. They spend the $23,000 when all they really have created was $1,000. And so keep that in mind when you're analyzing your financials and taking a look at those financials with everything that you're doing. So here's what you need to do. When you are trying to fix a business, you need to build up cash first and foremost. Build up your cash position. Get to that 45 days as quickly as you possibly can on everything. Next, you need to pay down the debt, but pay it down second. And you can pay it down aggressively, but not at a risk of your cash position. So if you're at 45, try to always stay at 45 as a floor. You get up to 60, pay some things down. And that's an important thing. $1 of current liabilities paid will equal $2 of current assets freed up. So paying down debt is good, but not at a risk of going to zero in your cash position with everything on there. All decisions need to be based on fact, not fiction. And that's an important part of this process as well. And it's not net income. We do not spend our net income. If we do, we're more likely to get in trouble. And that's an important part of that process. Now, to review, there are 3 key reports you need to look at. Number 1 being your balance sheet, your scoreboard. It's your risk assessment. You're up by 3 touchdowns. You're down by 3 touchdowns. You have 10 minutes left in the game. You have 2 minutes left in the game. It tells you everything. It's your instrument. So make all your decisions based on that. Your profit and loss statement is just the beginning, where so many business owners look at it as the end all be all. And that's the only statement they look at because it makes sense. They start up here with revenue. They end down here with how much cash. Is it negative? Is it positive? Woo, we made cash. Great. But they don't go on from there. And then finally, cash flow. That's all that matters in this game. The cash flow that's coming off your business is all that matters. So make sure you're taking a look at that and you're paying attention to that, because that's an important part of this process with everything. So know your numbers. At the end of the month, that should be the first thing you do. I have some tools. If you'll send me a direct message, I've got some real quick Excel spreadsheet tools to help you do this in 5 minutes or less. Just send me a direct message. Be happy to send those to you and help you out with a lot of that. And of course, I've said it several times here, make every single decision based on your numbers. That's it. Make them all based on your numbers, facts, not feelings. And you'll go a long way with your business, because the facts don't lie. That's the most important thing to remember. Now, where do we go from here? I'm going to give you some information. If you'd like to contact me, Todd at 8020businesscoaching.com is one way. Direct mail, message me. I'm on Twitter at toddknuckles.com. Same thing for Facebook. And because you attended today, you're eligible for a complimentary business and market analysis. At no charge, I will take your financials. I'll give you a financial roadmap. I'll take your organizational blueprint. I'll give you an organizational roadmap. And more importantly, I'll give you a sales and marketing blueprint using some proprietary software that I have, and help you out in this process. Hope you take advantage of it. It could make a difference for yourself over the next year or more. And thank you. Thank you for taking some time here. And if you have any questions, you know how to get a hold of me, and we'll be talking on the other side. I appreciate it. Thank you to each one of you. Thanks. Take care.